Hi guys, welcome back. This is our last chapter together. So we're going to be looking at monetary policy finally when we have concluded fiscal policy. So monetary policy is what the Federal Reserve is in charge of. Let's begin by looking at what money actually is. So what is money? We all know what money is. We have it. We like to have more of it, right? But what is it really? What makes money money is not what it's made of. For all we know is we wake up tomorrow, we decide we want Coke bottles to become money, and then they will become money. Money is anything that is accepted in exchange for goods and services. It's also a legal tender, meaning money is not money if it is not accepted as a repayment for debt. So I'll give you a little bit of a quick example. Up in the Berkshires, they have Berkshires. And basically what you can do is exchange $100 for $120 of Berkshires. And what this does is it gives you a 20% discount everywhere you spend in the Berkshires. Now, does this mean that that is money? It's not money. It's more like a coupon style to keep the money more local and to encourage you to spend more money there. Well, you can't take that and pay your American Express card, right? So it's not considered a legal tender for that reason. So anything that is accepted as a medium of exchange and it is a legal tender, then we call it money. It doesn't matter. Australian money is made out of plastic. There was a time when playing cards were actually used as money, so it doesn't matter what it is. Now, money has three functions. There are three things that money does. One is it's a medium of exchange. What does that mean? It's a medium of exchange. Right here, it means if I give you money, if I give you $15,000 for your car, and in your eyes that's a fair price to sell me that car, then I am exchanging the money for your car. That is a medium of exchange. Money as a unit of account. What does that mean that it is a unit of account right here? Unit of account means this is what it's measured by. It's redundant for me to say to you, hey, how many dollars is this? Really, I should just say like how much. Why? Because you're never going to say it's 100 potatoes, it's 1,000 bananas, right? It's always going to $100, $100, 1,000, $1,000. It's always what we measure by. And three, money as a store of value. It means if you save for your retirement and invest for your retirement, when you retire, people are still using money and you can still withdraw that money and spend it and live off of it. It's not going to expire. It's not some sort of temporary weird scheme. So these are the three functions of money. Now, what gives money its value? Obviously, you have a lot of details in your outlines and in your textbook, so this is just an overview to walk you through things, but I really do tell you all the key points, and they might even cover all the exercises. What gives money its value? Okay, nothing. Nothing at all. Not a gold standard, that's for sure. See, a very big X here I have, because I have students who tell me on their last test how it's a gold standard, and it's not a gold standard, okay? We don't actually have anything that backs it up except its general acceptability. So I have in parentheses here, in government we trust. Not, I know our money says in God we trust, but the truth is, if we no longer trust the government, then we no longer trust that the money it's printing has any value. And so what people do is they do resort to exchanging things. They create a barter system in that case, that where perhaps things are being exchanged that are not money. But that is not what an economy needs, and that is not healthy for an economy. So long we trust in the government. So that what I'm telling you is what's happening politically lately that's shaking people's faiths in the government, that is pretty bad business, because it will affect the value of our money. It definitely affects our investments and the value of our assets. And so this is why people are able to purchase anything. They're able to purchase anything because they're able to know that the money that they borrow is generally accepted, and they can therefore spend and earn assets, hopefully with more value. Are credit cards money? Well, heck no. So, okay, question for you. What is the number one answer of 5-year-olds in this country when asked, where does money come from? I'll give you a minute to think about, not a minute, like a second to think about it. Where does money come from? Okay, number one answer, ATM machines. And that is rather pathetic because we are not doing a very good job teaching our kids where money comes from. So kids see their parents going to an ATM machine withdrawing money and they think, hey, there's like this cash machine and it loves us. It just gives us money. Not that it is hard work. So clearly we need to do a better job explaining. Now, if an ATM, the concept of an ATM machine, how cash has to go in there from the parents before they can withdraw it is difficult enough. Imagine the concept of credit cards. I have a student who told me that one time she went shopping with her daughter and, the daughter said, can I buy this? And the mom said, we don't have money for that. And the daughter said, well, just charge it, right? Just charge it. Well, no, we're not going to do that. We're going to pay with yesterday's dollars. So what are credit cards if they are not money? Credit cards are short-term loans, right? The bank, you purchase something, the bank guarantees the seller a purchase, so you can walk out with the item, but you still have to pay the bank at the end of the month. So all they are short-term loans. Now, defining the money supply. The money supply comes in M1, M2, M3, right? So M3 is not a car. Like I had somebody ask me before, what is an M3? Is that some sort of sports car? No. You have M1 as in the money supply in its narrow form, M2, which is much bigger, but not as big as M3, which is all-encompassing. So what is M1? Currency held outside of banks. That's money in your wallet, right? Demand deposits, which basically means anything in checking account, and traveler's checks, because as you know, traveler's checks work like money. People prefer them because when they travel, they are not like cash. If somebody steals your traveler's checks, you can get them reissued. They work like cash. If you sign over $100 traveler's checks, like let's say 100 pounds and you're in Great Britain, traveler's checks, but you only owe 80 pounds, they give you back 20 pounds in cash. It's that good. The downside is not everybody accepts them, but they are as good as cash. M2 is all of M1 plus small denomination time deposits. So now we're talking about CDs, certificates of deposits, savings account, right? That's clear. Money market accounts. These are the checking accounts with check writing privileges that are rather limited. So you might have to give notice before you can close the account, as much as, 14 business days. You might not be able to go below a certain balance, but what it does do is it allows you to perhaps earn a little bit more interest. Overnight repurchase agreements and overnight euro-dollar deposits. Repurchase agreements are just like extremely short, very quick turnover type of loans. And then overnight euro-dollar deposits. This is basically any US dollar not in a US bank or not on US soil. You go to Canada, you take some cash with you, you exchange it over there, it becomes a euro dollar. M3 is all of M2 plus large time deposits. We're looking at humongous deposits, probably near this mark here of the FDIC. Institutional money market funds. Short-term repurchase agreements. So these repurchase agreements are no longer 24 hours, they're several weeks, and then larger liquid funds. So when you're dealing with, a little bit more complexity and larger sums, we are going into all of it into M3. And the FDIC insurance is $250,000 in case you are kind of wondering, per bank, for each account ownership category. Now, fractional reserve banking. Okay, what is fractional reserve banking? This is what we have for a banking system in this country. It's called fractional reserves because when people deposit money in deposit accounts, meaning in checking accounts, that money is separated into required reserves and excess reserves. Required reserves are around 10%, and the banks are required to hang on to them. Why? Because people might show up. You have the right, if you have $1 million in a bank, you have the right to go to the bank and say, I want my $1 million in cash. And they need to have that cash for you. Now, people aren't doing that. Doesn't seem wise, does it? But you can, and the bank needs to be able to get their hands on that money so they can't actually, have no cash at hand. Excess reserves can be lent out. So here's basically our fractional reserve banking right here. Here's a depositor. This depositor is depositing money at a bank, any bank at all. This bank ends up keeping that 10% in reserves, holds a small fraction back, about 10%, but is able to invest. By invest means lend out that 90% to someone else. So here's an example right here. You have a gentleman depositing $2,000 in a bank. The bank is going to hang on to $200, keep it in required reserves, that's the 10%, but this bank can lend out $1,800 to another individual, and that individual can spend it in whichever way they're going to be spending it. Okay, I'm going to stop right here, and when we come back, we'll talk a little bit more about this. So I'll see you in video 2.